The UK non-dom regime is over now, and it's been replaced by a completely new foreign income and gains regime. From April 2025, the remittance basis was abolished. Domicile no longer drives UK international tax planning. We are now operating under a residence-based system, and the rules are fundamentally different. If you are moving to the UK, returning after years abroad, investing overseas, or earning foreign income, this changes directly affects you. In this video, I will explain what replaces the remittance basis, what the rising basis now means for UK residents, who qualifies as a qualifying new resident, how the 4-year FIG relief actually works, what income qualifies and what doesn't, how foreign capital gains and trusts are treated, and how to correctly claim relief on your UK tax return. Because this is where mistakes happen. Get it right, and certain foreign income and gains could be exempt. Get it wrong, and you could lose your personal allowance, your CGT exemptions, and trigger unexpected tax exposure. The FIG regime is not a loophole. It is a tightly drafted replacement for the non-dom system, and 2026 is a pivotal year for UK international tax reform. So, if you want clear, practical breakdowns of major HMRC changes, subscribe now. Let's unpack the FIG regime properly. What has changed? Under the old system, domicile was the key concept, but now domicile is no longer relevant for income tax and capital gains tax purposes. Instead, the arising basis applies to all UK residents. The statutory residence test determines residency, and a new FIG regime gives limited relief. Let's break that down clearly. Arising basis. What does that mean? If you are UK resident under the statutory residence test, you are taxed on your worldwide income and gains as they arise, not when you bring them into the UK, not when you remit them. When they arise, this is a fundamental shift away from remittance basis planning. So, if you are a UK resident and earn rental income in Spain, dividends in Dubai, or sell US shares, those are taxable in the UK in the year they arise, unless you qualify under the new FIG regime. Who is a qualifying new resident? This is the key gateway. To access the new FIG regime, you must be a qualifying new resident. There are 4 conditions. Number 1, you must be UK resident under the statutory residence test. Number 2, you must have been non-UK resident for 10 consecutive tax years before arrival. Number 3, you must be within your first 4 years of UK residence. Number 4, you cannot be a member of the House of Commons or House of Lords. Let's unpack this with an example. Alan moved to the UK on 6th April 2025. He has never been a UK resident before, so he passes the 10-year non-residence test. 25-26 is year 1 of UK residence. He qualifies. He can claim 100% relief on eligible foreign income and gains for 4 tax years. That means if Alan has rental income from Bali, dividend from UAE companies, capital gains from overseas shares, those can be exempt from UK tax if properly claimed. But this relief is not automatic. You must claim it. How do you claim FIG relief? This is critical. The relief is claimed via your self-assessment tax return, specifically on the SA 109 supplementary pages. You must quantify the foreign income and gains. Claims are made separately. It must be done year by year. This is not a blanket election that covers 4 years automatically. You must actively claim in each year you want relief, and the amounts must be itemized. For example, foreign rental income £45,000, foreign dividends £12,000, overseas capital gains £60,000. Each source must be declared even if relieved. Declaring for relief purposes is no different than declaring foreign income under an arising basis. You must disclose it. Transparency is now central to HMRC's approach. For example, Rita is a qualifying new resident in 2026-27. She runs an overseas property business in Germany. Her profit is €70,000. If she qualifies under FIG regime, that €70,000 can be exempt from UK tax for that tax year if properly claimed. But she must declare it, convert to GBP, claim the relief, itemize it on the supplementary pages. This is compliance heavy. You cannot ignore disclosure just because it is exempt. Claims and years. Now, here is something very important. You do not have to claim all 4 years. You can claim fewer than 4, but the 4-year clock starts from your first year of UK residence. It doesn't pause, it doesn't restart, it doesn't extend. If you do not claim in year 2, you don't get an extra year at the end. For example, Sarah lived in Australia for 15 years. She returns to the UK in 2025-26. She claims in year 1. She does not claim in year 2 or year 3. She claims again in year 4. That is allowed. But year 5, finished. Relief ends permanently, even if she only claimed twice. For example, Chris lived in Dubai for 10 years. He returned in 2023-24, but the regime only starts in April 2025. So 23-24, not eligible. 24-25, not eligible. 25-26, year 3 of residence, but year 1 of regime. Depending on transitional rules, he may not qualify if he does not meet the 10-year consecutive non-resident rule immediately before regime start. Timing matters massively. Arrival dates matter. Tax year classification matters. Residence history matters. This is not casual planning. Effects of making a FIG claim. When you claim the FIG regime, you are choosing to exempt certain foreign income and gains from UK tax. But it comes with consequences. Number 1, loss of personal allowance. If you claim the FIG regime in a tax year, you lose your personal allowance, blind person's allowance, and marriage allowance reductions. So this is not a free exemption. For example, Ali moves to the UK in 2025. He has £40,000 UK salary, £50,000 foreign dividends. He claims FIG. The foreign dividends are exempt, but he loses his £12,570 personal allowance, so his entire £40,000 UK salary becomes taxable. That is the trade-off. Number 2, adjusted net income impact. Normally, foreign income increases your adjusted net income, affecting child benefit, high income charge, personal allowance, taper above 100K, certain reliefs under FIG. Qualifying income is ignored for UK tax, but you must still consider how HMRC applies rules carefully. This is technical territory. and incorrect planning here creates surprise tax bills. Number 3. Capital gains annual exemption. If you claim FIG, you may lose access to certain capital gains annual exemptions in that year, meaning strategic timing matters. What qualifies as foreign income? Now, let's talk about what actually qualifies. This is where most confusion happens. Qualifying foreign income includes number 1, profit of a trade carried on wholly outside the UK. For example, Maria runs an online business operating entirely from Dubai. No UK office, no UK permanent establishment. If she becomes a UK resident and qualifies under FIG, those foreign trading profits can be exempt. Number 2, profits from overseas property business. For example, John owns rental property in Spain. Rental profits £30,000 per year. Under FIG, this foreign rental income may qualify. Number 3, foreign bank interest. Interest from Swiss accounts, UAE accounts, or US brokerage accounts. This is qualifying foreign income. Number 4, dividends from non-UK resident companies. If you own shares in a US corporation, a UAE company, an Indian listed company, those dividends may qualify. Number 5, UK resident partner's share of foreign trade. If you are a UK resident partner in a partnership trading wholly overseas, your share may qualify. Number 6, certain foreign pension income. But this is critical. Not all pensions qualify. Number 7, certain income under settlements legislation, trust and anti-avoidance rules may still apply. This is where structuring matters significantly. Disqualified income. Now, here is where many people get caught. Not everything foreign qualifies. Disqualified income includes performance income. If you are an athlete, musician, public speaker, and your income relates to UK activity, it may not qualify. Number 2, certain pension income. Some overseas pension structures don't qualify under FIG regime. Number 3, income treated as UK situated securities, complex share exchanges involving non-UK close companies may disqualify income. Number 4, transferred income streams. If income has been artificially diverted, anti-avoidance rules apply. This is HMRC tightening loopholes that existed under the non-dom regime. Foreign capital gains. Now, let's talk about capital gains. Under FIG regime, qualifying foreign capital gains can be exempt. Sophie owns a US shares purchased years ago. She will sell them in 2026. Gain is around £200,000. If she qualifies under FIG regime, that gain may be exempt from UK capital gain tax. But timing is everything because you must make a valid claim. Trust and transfer of assets abroad rules still apply. You may lose capital gain tax annual exemption that year. This is strategic territory, not DIY territory. Trust income and gains. Now we get to advanced planning. If you are a beneficiary of an overseas trust, you must make your own claim on your personal tax return. Trust income does not automatically become exempt. There are separate HMRC guidance sections covering income from trust, foreign capital gains via trust. You receive £50,000 distribution from offshore trust. Whether that qualifies depends on type of trust, when created, settler status, source of underlying income. Trust structuring under FIG is highly technical. Record keeping requirements. If you claim FIG, documentation is critical. You must retain overseas payslips, bank statements, dividend certificates, rental income statements, evidence of foreign tax paid, sale agreements for assets, share disposal confirmations. HMRC will expect evidence, and under digital reporting expansion, data sharing is increasing globally. The UK foreign income and gains regime is generous, but it is narrow. It benefits high net worth individuals relocating to the UK, entrepreneurs with offshore companies or structures, expats returning after a long break in UK residence, but it does not benefit long-term UK residents, short-term movers, anyone with broken or complex residence history. And here is what many people are missing. The compliance burden is higher than the old non-dom regime. HMRC wants data, they want transparency, and they expect structured reporting. From April 2025, the FIG regime replaces the non-dom remittance basis. If you qualify, foreign trading income may be exempt. Overseas rental profits may qualify. Foreign dividends and interest can be exempt. Foreign capital gains may fall outside UK tax. But there is a trade-off. You lose your personal allowance. Some income is specifically disqualified. Trust rules still apply. Anti-avoidance legislation remains firmly in place. This is not a loophole. It is a tightly drafted transitional regime. And if you structure it incorrectly, you could end up paying more tax than under the old non-dom system. Plan properly or pay unnecessarily. If you are planning to move to the UK in 2026 or previously relied on non-dom status, planning before arrival is critical, as your arrival date is not just a diary decision. It is a tax decision. Subscribe now so you don't miss the FIG regime series.